What's going on, Bag Brigade? It's your boy, Chuck Taylor, Chuck Dizzle, Chuck Boomberg, coming at you live and direct. It is Saturday, May 17th. And I want to go over some stuff. Basically, what I want to go over basically is what happened this past week and what to expect for next week. And we're going to go a little step by step on that, all right? Bear with me. What you are looking at right here, now most of you who are probably watching this video do know what this is. This is the Bag Brigade Discord community. But for anybody who is finding this video on YouTube or whatever and knows nothing about us, this is the community. I'm not going to go through the whole thing. I'm not going to do that right now. But we do have trade alerts, algo trade alerts, data, lots of great analysts, education section, so just all sorts of stuff. But again, I'm not going to go through it all right now. If you would like to join, there will be a link in the description of this video, as well as there's already a link on the YouTube profile page, as well as Twitter. So you can easily find it. Now, when you click the link, it's going to ask you, you're going to have to apply. It's going to ask you how you found us, why do you want to be a part of this community, and you have to agree to the rules. Okay. You can read these later, but just saying. Anyways, so let's talk about something here real quick. This is SPY, right, on a daily time frame. And these are the moving averages. So I have these lines drawn, and I'll explain why what these levels are, okay? Well, obviously you can tell this is all-time high, right? That's the top right there. And then this is their most recent low. And where did I get these levels from? I mean, you can kind of see that that's obviously a level. There's many levels in between too, little mini levels, but yeah. I mean, what I'm getting at is, and I'll get into that in a second, but I just want you to see some. I want to explain something to you. So, first of all, this reminds me, I don't know how many of you were trading in 2022, but this reminds me of 2022 significantly. Why do I say that? Well, first of all, I can draw a fib if I want, but well, no, we don't need to do that right now. But what I'm getting at is just look at this. Just snap a screenshot in your head of this, okay? All right, look at this. Now, let's go back in time. Look familiar? This is 2021. Kind of had a big drop to kind of have a little bit of recover, and then whatever, big drop, and then recover, and then boom. I mean, we just kept going down and down. It just looks very, very similar, okay? The only difference this time is from peak to trough. So that was basically January 4th of 2022 all the way down to October 13th of 2022. That was a 281 day period, basically about 9 months. And we did a total drop of about almost 27%. Okay, so with that being said, let's do the same thing for this. Okay, so this is crazy. So we dropped almost 22% in about 6 weeks. Okay. And then from the bottom, from the bottom to where we are now, right? It has only been 39 days. So just over a month, and we have recovered 19% of that 22% drop. So you're literally talking about, I mean, if you think about it, about 2.5, 3 months total to go all the way down 21%, 22%, and then come back up to be at a 19% run back up to be about 2% off from the all-time highs. That is extremely aggressive. Like I just showed you 2022, how long it took. I mean, these are violent moves. Now you can look at this in several different ways as technical traders look at all sorts of patterns, right? So what is this? Is this going to be a V-shaped recovery like, you know, when the Fed stepped in 2020? We're going to see something like that? I don't think so. Because the Fed, this was COVID. I mean, they injected, you know, the Fed stepped in and trillions of dollars were printed, and yeah, V-shaped recovery. Well, that's not the case right now. Like that's totally different. I mean, this is all due to rate hikes, right? 2022 bear market. But this is all tariff stuff and just absolute uncertainty. And so you can look at this in two ways. I mean, yeah, okay, maybe it's a V-shaped recovery and we go back to all-time highs. I don't know. I tend to not believe it, but we are above all of the major moving averages. You have your 5-day is the yellow. You have your 20-day moving average is the green. You have your white is the 50-day. The purple is the 100, and the orange is 200-day moving average. I mean, that being said, though, look, I mean, you did get a double death cross here, right? The 50 crossed below the 100. It also did the double death cross. It crossed below the 200. Okay. Now you're getting the 50 that cross like above the 20, which I don't think means much. But what I'm trying to say is this looks bearish for multiple reasons to me on the daily. This is just a completely overextended, and in history, you go back in time and look. You know, and with the RSI right here, I mean, it's just overbought. Okay, it's right at the overbought level, and we also have a TD9. It's like TD sequential 9 print, a red 9. So if you'll notice, anytime you get a red 9, it doesn't happen immediately, but there typically is it's a shift in direction of price action, right? Same thing with a green 9, shift in the actual price action, right, to the upside. But yeah, we just got a red. So bearish, that's bearish. This is bearish. This is bearish. These gaps right here, those are bearish, right? Just from a technical standpoint. Now, if we look at the weekly, kind of a different story. Definitely have not reached the oversold on the RSI yet. In this thing, the MACD, the moving average convergence divergence, is looking like it wants to swing up the other way. You are above all major moving averages on the weekly, and you do have a green 9 printed. Okay, so again, these things don't happen immediately. So when was the last time we had a green 9 printed? There's a lot of red 9s, but geez, honestly, that's odd. I don't even know. There really hasn't been, at least on the weekly, a green 9 print since even before COVID. This is the first time on a weekly. Wow. Okay, I did not realize that. Interesting. I mean, I can't even tell you the last time we actually on a weekly had a green 9. They're all red 9s. We'd have to go back. Here is a green 9. This is 2016. That was the last time a weekly printed. That's wild. Okay. Anyways, well, what I'm getting at is this looks bullish. Okay, but then let's look at the monthly. This does not look bullish to me. This looks bearish. Yes, you are above all major moving averages on the monthly, but you do have a red 9. Okay. The moving average convergence divergence is crossing over. The RSI is definitely in overbought territory. You're getting there again. Yeah, I multiple things can be happening here. Honestly, I mean, you have to think about it. If we look back at a daily, and people, who were buying SPY up here or whatever, or they feel like they missed their opportunity to get out and sell, right? And then you obviously had dip buyers. I mean, that would have been great dip buy opportunity. So there's a few things that are happening right now that also can turn this thing really back, like into one of the biggest bull traps I think we've ever seen. Well, one of them is that as these levels, we start reaching back to these levels, the people who missed the opportunity to sell towards the top are going to start selling. Okay, they're going to start securing their profits. Okay, so that's going to add downward pressure. 1, 2, you do have to understand that there's quite a bit of short interest on it on SPY, and on any of the other ETFs. But what I'm getting at is, there's institutions and hedge funds that were definitely shorting on this, and now they're getting into a position where they're going to have to cover their shorts, right? So what does that mean? They have to buy the stock, or they have to. It's a combination of, like, I don't know what's going to happen here, because like if they start covering their shorts, they have to buy the stock. That could bring prices up. At the same time, you're going to have profit takers. Anyways, I'm just trying to make you understand what's going on. You could also look at this at, what is this, a V-shaped recovery, or is this an inverse head and shoulders, right? Because it could be an inverse head and shoulders, which is a bearish move, or it's a bearish pattern, right? So we shall see. We shall see. But that being said, I need to show you something. If you missed the market today, or sorry, yesterday, you will probably have noticed something like this. So this is basically the last week of trading. And this was Monday, the 12th, right? The gap up from the quote unquote good news from China, the trade deal, which I'll get into that a little bit more, but that's a pretty massive gap up, right? So, and then obviously you kind of just melted your way up. But what happened today? after the market closed? Why did that we just erased not only the entire day's worth of gains, but we even cracked into the prior days? Oh, I'll tell you exactly what happened. This is what happened. Moody's downgrades United States credit rating, citing growth in government debt. Of course, they chose to do this literally like 30 minutes after the market closed. You know, they purposely do this kind of stuff. To get into a little bit more depth on that, so there's three ratings companies, right? There's Moody's, there's Standard and Poor's, which are the two top ones, and then there's Fitch. So what we're looking at, well, here, let me run through this, and this will make a little bit more sense here. So this is the S&P 500, right? And let's just pretend this is the S&P 500 as well. So, or SPY, whatever. Like, so if SPY really just crowned this as the top before nosediving into a proper market tantrum, okay, return to normal, hats off to Wall Street. This was a deviously well played trap. Like I said, this could be one of the greatest bull traps ever. We did get that sweet gap up, right? Like I was showing you right here. Yep, we got the sweet gap up, slicing right through the 9-week base resistance like it owed us money. The market even flexed by clearing the 5, 9, 20 EMAs combo, whatever, and the 50-day moving average, as if it was saying, relax, buddy, we're headed back to all-time highs. Just buy the dip again. Everyone got comfy and returned to normal lounge, sipping hopium cocktails, thinking this was the glorious comeback. But this chart right here is our fate. We're teetering right at the bull trap ledge. Okay. Moments before fear and capitulation decide to host their annual reunion tour. So yeah, if we roll over from here, which we possibly could after this Fitch thing, consider this a masterclass in how the market, politely mugs the public, one paradigm at a time, sort of thing. So here's a little background on Moody's. So Moody's rating history. Moody's was like the last major ratings agency to maintain a AAA rating for the U.S. until yesterday, May 16, 2025. The first downgrade, the May 16, 2025 downgrade to a AA1 was the first actual rating downgrade by Moody's for the U.S. sovereign debt in recent history. The prior actions before yesterday's downgrade, Moody had only issued negative outlooks for the U.S. debt rating in 2011, 23, but they did not downgrade us. Like in 2011, Standard & Poor's did. 2023, Fitch downgraded us. And what this chart is showing you, or this table of numbers, is basically, so we're going to not count 2023, really, the Fitch one. This is the Standard & Poor's 2011 one. So like that was like the last major credit downgrade announced after hours, which is August 5th of 2011, right? So here's where we were, 122.07, or maybe that was the high of the day. I think that was low, and maybe that's the closing price. I'm just going to assume something like that. Either way, it resulted in a market decline on the following trading day, which would be Monday, August 8th, which was about, 7%. Yeah, right there. So 112, I believe. Yeah. Anyways, however, though, the market, did recover, I think, fully by the 15th. Is it the 15th of August? Yeah. But just to come back and test the lows on August 22nd. So I believe this coming Monday is going to be pretty bloody. Just kind of based off that Moody's has never given us a downgrade before. They are now the last one out of the three to do it, and actually between all three of them, Moody's and Standard & Poor's are the big ones. Fitch is kind of, you know. Shout out to Fitch. So what we're looking at here, like this is the S&P's 500 recovery has been the most rapid since the 2020 like COVID crisis, right? We haven't seen, a recovery this quick since then. But there's a difference, honestly, between the two, because in 2020, the Federal Reserve and the U.S. government injected over $5 trillion into the economy and markets through stimulus measures. This time, the rally has basically been fueled by enthusiastic retail investors making substantial purchases. I mean, it's kind of the truth. The question that remains is, will this recovery be sustainable? I do not believe so, for many reasons. And now that we have the Moody's downgrade, I think that could begin the next leg down. So here's kind of like a chart real quick, right? At Moody's, S&P, and Fitch, right? So, AAAs are prime, high grade, AA1s, AA2s, AA3s, upper medium. It's just, and here's Fitch's, Moody's, and all that shit. When you get below the BBB negatives, this is when things start to get really bad. Like, it's like junk bond kind of stuff. So we're not anywhere near that. It's not something, but just to be downgraded though is just not a good thing. It just shows that our economy is trickling in the wrong direction. And then of course you get old Oompa Loompa Trumpy Dumpy over here on True Social and Twitter, X, whatever, because this is Biden's credit rating. Everyone is obsessed with this is Moody's, that. How about you Moody's tariffs and let me do my job? I mean, what? You can't make this shit up. My God, this is such a clown show. It's comical. I mean, it's comical, and you gotta. I mean, if you're a trader, you gotta love the volatility. I mean, this man he's not even a Democrat or a Republican. Like I like to call them the Crips and the Bloods, blue, red, whatever. It's basically all the same thing. I mean, he's like in a land of his own. I mean, Mr. Orange Tangerine looking skin. Like, I'm just going to call him the Oompa Loompa gang at this point, because it is a clown show, people. I mean, it's what we are witnessing is an absolute circus. Something interesting, and I follow this a lot. The CMBS market, which is the commercial mortgage-backed securities for like commercial real estate, like assets, office buildings, multifamily, retail, all this. But the one you're looking at right here is the office CMBS delinquency rate. So like bloody hell. Now I've been saying this basically since 2020. I knew something was coming. And there's reasons for it. But basically, look, the delinquency rate on U.S. commercial mortgage-backed securities, the CMBS market, for offices surged to an alarming 10.3% in April, reaching the highest level ever recorded. Okay? I don't think people understand how much money is tied into the CMBS market. Like, these are loans, basically, is what that is. Commercial mortgage-backed security is a loan, and it can be structured in different ways that landlords or REITs or whatever will take out. They tend to be like 10 years, and 10-year long terms, and basically, depending on how you structure it, but yeah, because nobody is just going to go build a brand new office building and pay cash for it. Just you don't do that. You do a CMBS, mortgage-backed security loan. Problem is, and why the delinquency rate's so high, is because COVID exposed so much. It's why our world has changed so much since it happened. I mean, it basically exposed the fact that, well, first of all, office real estate prices per square foot is the most expensive out there. And so why didn't it happen immediately, right? In 2020. I mean, you did see a little spike here, but why is it all of a sudden doing it now? Well, because you have to think about it like this. When COVID happened, there was a bunch of big tenants, like big companies, like that had, multiple floors of office space or whatever. But the thing is, their leases they have expiration dates, and what's happening and what you're seeing is a multiple of things. You're either seeing companies completely just completely not have an office presence because, by the whole working at home thing with Zoom and all that, it did show that you do not need to have everybody in the office and pay for all that expensive real estate. And so what's happening is either companies are downsizing significantly, or they're just not renewing their leases and they're going all remote. I mean, there's a lot of different factors here. But you have to understand something. The landlords or whatever, they depend on the cash flow of the leases. Okay, the monthly payments on the leases to cover these CMBS debts. And when these leases stopped, weren't getting renewed or significant downsizes, that really makes it more difficult for them to pay their monthly CMBS payments, right? If they're dependent on that cash flow. So that's what you're seeing. That's exactly what you're seeing. Okay? That's why the delinquency rate is so high on the landlords paying these debts back, because the tenants are there, or they've downsized so much. And with interest rates as high as they are, doing a refi at a higher interest rate doesn't make a lot of sense, right? I mean, there's all sorts of ways you can look at it. There's special services. There's ways that they can be worked out, but you have to ask yourself: is the office market ever really going to go back to what it was? I don't know. Maybe. I mean, I'll tell you what. If you could get enough investors involved or whatever, this would be an amazing time to buy office assets. I mean, you're literally seeing buildings go for sale, like office buildings that were probably bought for just under $1 billion, like let's say 800 million in 2019. They're getting sold for like 100 million. Now, that's a huge discount. So there's opportunities there, right? But there's also risk. I mean, they also talk about converting some of these buildings into livable, places. The problem with that is it's doable, but the problem with it is to convert an office building into like a living type of situation, you have to have openable windows. One, office buildings tend to not have those. Two, you got to completely restructure the plumbing. You have to have showers, because office buildings have bathrooms that shared down the hallway. So to reconvert it is not going to be cheap. One, because of just the inflation on raw materials, and especially with the tariffs and stuff, that's going to make it even more complicated. But also you got to realize nobody's just going to go and do these projects in cash. They are going to need to take out a construction loan. Well, take out a construction loan with interest rates still at 4.5%. It doesn't make sense to do it. So what am I getting at here, right? What am I getting at? Most of these CMBS loans are issued, most of them, not all, are issued by regional banks, some of the smaller banks, because typically these regionals are, focused in certain areas, and when you have bigger banks that are all over the place, it makes more sense sometimes for a landlord or a REIT or an institution, whoever's wants to build this building or buy this office building or whatever the case may be. Yeah, I mean, I lost my train of thought there. Well, I'm just saying, you can't refi at high rates, right? So the regional banks. So what happens when they default, right? So there's a couple things that can happen. Like the first of all, the bank who issued the loan is going to take back the building, which is technically now going to be a zombie building. Now they will auction them off. There probably will be buyers, but if too many of these things start defaulting at the same time, these regional banks are going to get overloaded, and they're just going to be having a bunch of zombie buildings on their books that have zero value. Basically, it's like holding like debt, like a toxic asset at that point to these banks. And if it all happens fast enough, what's a bank going to do with his own? I mean, they're going to try to auction it off, but if they can't even sell it, so what's going to end up happening is you're going to see a lot of bank failures, a lot of regional bank failures from this, because this is a hundred, the CMBS market's hundreds of billions of dollars of loans that are potentially going to be defaulting here. So I don't know, but it is kind of like a black swan event that you're not really hearing much about. I mean, and it even gets worse in that. That's just the office market, okay? But furthermore, like the multifamily delinquency rate experienced a significant increase of like 113 basis points in April, reaching a staggering, I think it was like 6.5%, 6.57, the highest since 2015 for like I said, for multifamily. But for office, we're at all-time highs on delinquency rates right now. I mean, the commercial real estate crisis is intensifying, to say the least. This is a shot of the U.S. home price history from 1890 to 2025. And basically, it's this pretty incredibly alarming statistic, when you consider adjusted for inflation. I mean, U.S. home prices are now significantly higher than they were at the peak of the 2006 housing bubble. Just like housing affordability in the United States has never been in such a dire state. I mean, this is a genuine crisis. You mix that with the commercial real estate stuff. I mean, will the situation be resolved soon? I don't know. But I can tell you this: I don't own a house. It's way more, makes more sense for me to rent at this point. And I don't know if we're gonna get a big dip back down like we did in 08. I don't know. We might. But the thing is, I mean, dude, everybody, I mean, unless you make like, you're a millionaire. I mean, honestly, basically, you have to have like at least $1 million. I mean, you can't. It's the middle class is getting totally fucked right now. That's what's happening. That's exactly what's happening. I mean, you got people in their 30s, people in their 40s, people in their 20s. They can't even buy a house because two things. I mean, first of all, the cost of the houses are extremely overpriced, and then you have the interest rates that are high on top, the mortgage rates. So it's not like it was back, in the boomers' days when they were, in their 20s, 30s, or 40, whatever. I mean, they were able to buy, a house, with just the man working in the family and covering it. You know what I mean? Like, it's a serious issue. I don't know what's going to happen. I really don't. Right here, we are looking at this is the Japan, I think it's the 30-year. Now, this is the Japan 40-year government bond yield. So the Bank of Japan is in a dilemma, like torn between responding to their weak economy with stimulus measures or resorting to raising interest rates to protect their currency by eliminating the yen carry trade, like what happened back in August of 2024. So this is kind of concerning, to say the least. It's basically at multi-decade highs. I don't even know. I'd have to go back and look. But I mean, my God, we haven't seen. I mean, this is bonkers right here. I had to talk about this too. This is just so funny, bro. Trump is so funny. Such a clown. I see the highly overrated Bruce Springsteen goes to a foreign country to speak badly about the president of the United States. Never liked him. Never liked his music or his radical left politics. And importantly, he's not a talented guy. Just a pushy, obnoxious jerk who fervently supported crooked Joe Biden, a mentality incompetent fool, and our worst ever president who came close to destroying our country. We get it, Trumpy. You pretty much say it every single day. If I wasn't elected, it would have been gone by now. Sleepy Joe didn't have a clue as to what he was doing, but Springsteen is dumb as a rock and couldn't see what was going on, or could he? Which is even worse. This dried out prune of a rocker, his skin is all atrophied, ought to keep his mouth shut until he gets back into the country. That's just standard fare. Then we'll all see how it goes for him. That is our president, ladies and gentlemen, who literally will get on Twitter and Truth Social and say whatever the fuck he wants. I mean, and that is crazy because it moves the goddamn market. Like I said, the NASDAQ 100 will soon, and, pullback is expected, right? Like I said, bearish divergence on the RSI. I'm sorry, RSI right here. And a forming rising wedge pattern suggests a potential pullback, right? Rising wedge, pullback. The Elliott Wave count, if you believe in the Elliott waves, the current move is likely minor wave 1, which is expected to be followed by a pullback to minor wave 2, putting the NASDAQ basically at, and these are all the gap fills too, putting it back right at the peak. What basically, this is hilarious, but basically almost right back to where everything started, right? This is too crazy. Like that's, yeah. Because like right now we're basically kind of like we're, right before the market even started going down, we're almost back at that level. I mean, and if we come back down here, then we're right back in the middle of all of this. So I don't know. I found this chart interesting, and honestly, I kind of hope that is the case because at the end of the day today, right before the market closed, I did grab QQQ puts. If you don't, QQQ is the NASDAQ ETF, exchange traded fund, which you can actually trade options and stuff on. So right before the market closed, I was just doing a little bit of looking, and I was checking things out, right? And I said, okay, if this thing does come down, if it rejects, like, you know what I mean? 510 is the not only it's a couple of things. It's on the hourly, is the R3 pivot, resistance 3 pivot, which would now become support, right? At the same time, this is fibbed out, right, from top to bottom. That's also the 510 level is the 78.6 fib level, and you have mini gaps, you have big gaps below that, right? So what I'm trying to say is I chose that for a reason, because if we topped out yesterday, okay, if we did, which it looks like after the Moody's thing, it looks like we did. I mean, look, we closed at 521, and after hours it went all the way down to 514.63. So I mean, if this continues to sell off and open up Monday down at 510, those put options are going to absolutely print probably 500, 600%. I don't even know, but we'll see. I mean, we're just gonna have to see what happens. But anyways, I just wanted to share that. Okay. So, and if I do this and I turn this to a logarithmic, this is going to kind of like adjust the chart for inflation and dividend payouts and stuff. So I want you to notice something here on the SPX. The monthly, or we can look at the weekly. I don't care. But what I want you to notice something though. It's going to be important. So let me maximize this screen. And if I go back to a linear chart, right? This is a linear chart, right? So what it's doing is it's not like a linear chart is just what is showing you like through time, like, without adjusting for inflation, basically, right? So this looks really aggressive. This looks pretty aggressive. This is COVID. It looks pretty aggressive. I mean, compared to this, I mean, this is almost more aggressive than COVID. I mean, this was 2018, the Christmas Eve massacre sell-off. I mean, all these moves, which at one point, were looking, back when they were happening, were pretty massive, right? And I mean, look, here's 08, right? I mean, if you look on a monthly, you can see it, right? Remember, this is a linear chart. So look, you would think like 08 was horrible. The dot-com bubble was horrible. I mean, dude, those were like 2 years. Well, I know that the dot-com bubble was from top to bottom, a 50% drawdown, and it was like a 2.5-year bear market. And then I think 2008 was like a year and a half bear market, and it was a 56% drop. So you have to understand something. This is bad. These are bad, and this looks more aggressive. Well, there's a reason for that, because it's a linear chart and it's not adjusted for the inflation over time. Now, if I put it on logarithmic, now you can see, right? This puts things into perspective a little bit, I guess. This doesn't look so aggressive anymore, does it, compared to this? Okay? So just keep that in mind. I'm not by any means saying that. I mean, look, bro. This is what the MACD looked like right before we went into the 2022 bear market, and it looks exactly the same right here. I mean, it looked a little different back there, but I'm just saying, like, if this doesn't tell you something, it looks pretty damn close. Remember, we're on a monthly chart here. Yeah, I mean, this looks so similar to 2022. It's crazy. It's crazy. Let me go back to the linear. So anyways, if you didn't know about that, you just learned something new. Also, something to notice, right? This is a weekly chart, right? When these bear markets tend to happen, again, this is the dot-com bubble. It is very rare to break below the 200-week moving average. Now, the 200-day, not so much, but you did it in the dot-com bubble. You definitely did it in 08. Okay, but then I want you to notice something. Basically, after 08, I mean, except for right here in 2011, which was the other downgrade debt ceiling crisis thing, look where it tagged us. Look where it's like, look where it stops itself. You see? 200-week moving average, right? And basically, we haven't broke below the 200-week moving average. I mean, well, okay, look, this is 2015, I think 2016, like the whole oil bust situation. And then this was 2018. Look where it's bouncing right off the 200-week. Okay, COVID. I mean, we did break below it, but we recovered pretty quickly. I mean, we did break it, but very briefly. 2022, the bottom of the market was the 200-week moving average. Okay, so literally, we really haven't broken below it since 08. We did come damn close to touching it here too. So it does make sense, for these levels, like for bounce levels. I'm just saying, I'm just pointing out things that maybe you never thought to think of, kind of thing, So, but at the end of the day, also, I mean, you do have to realize, it's not just about the S&P 500. It's not just about SPY and Tesla and all of that, right? I mean, it's really, you need to be, you could do whatever you want, but this is what I do, and this is what, Too Woke and, Gammonomics. I mean, we don't just pay attention to, SPY. I mean, we obviously like look at it, right? But right now, look, Trump doesn't care about the stock price of Tesla or what the S&P 500. Neither does Jerome Powell. They don't care about that. You know what they do care about? Bonds. Okay, this is TLT. This is the 20-year plus U.S. Treasury bond ETF, right? And this is an hourly chart. So understand something. So TLT bonds down equals yields, like bond yields up, right? So this is very correlated. It's correlated with like the 10-year yield, basically. Yeah, I bet I'd probably have to do it on TradingView. It doesn't matter. What I'm saying is, bond TLT, like bond prices drop. That means that the yield, so whatever day this was, January 14th, I don't know, where was the TNX on January 14th? TNX is the 10-year yield, by the way, just to let you know. Let me turn off this indicator. Okay, so January 14th, remember I said this is TNX, which is the 10-year yield. January 14th. Oh, wow, look at that. See? Now watch this. TLT. So you can do a comparison. They are completely inverse of each other. 100%. So as bond prices drop, TLT. As bond prices drop, the yields go up. As bond prices go up, the yields go down. So right now, the yield, well, TNX is at, or the 10-year yield technically is sitting right around, I think it's like 4.5. I'm not really sure. Yeah, about almost 4. Yeah, like it kind of like tapped 4.5, 4.5%. I mean, the highest that we got the 10-year yield was, I believe it was in 2023. Yeah, we hit, we literally like got like right up to 5%, and then then bonds got bought up, and that means yields go down. But see, we're approaching. See, this is the thing. We're approaching critical levels on the 10-year yield. I mean, the last time you've seen the 10-year yield, even this is a monthly chart, but you have to understand something. Where's 08? So the bond, I mean, when they put interest rates like basically to zero for almost a decade, I mean, like this has just been in a straight downtrend, like no joke, straight downtrend since like the 80s, almost to the T, right? But that trend has now been broken ever since basically COVID. Okay, so the 10-year yield, hasn't really seen these levels that we're seeing over the past couple of years since basically 2007. And if you want to do like a median price or like a median level on bonds, like the 10-year yield alone, just over its history, I mean, you're looking at something like 7%. Okay, so we can't like going back to a like zero interest rate environment. Like, see, that's the problem. That's what happened. They lowered rates so low for so long that the markets have a tantrum when when interest rates are back up. I personally do not think Powell should be cutting rates at all. Honestly, I think he should just leave them where they are. And honestly, I think that's what he's going to do. Now, here's the caveat to that. Powell, like, let's just put it this way. If he were to do like a 0.25 basis cut or something like that, that's not really going to change much. Okay, that's not a big thing. But what could change, and the only way this is going to happen is if something within the economy breaks, right? That is when you can potentially see like what they call the emergency Fed meeting rate cut decision kind of thing, and that is not well. It's bearish typically at first because if you look at charts over history, when the Fed does raise rates and then they pause and then they drop drastically back down to zero or whatever, it's basically because something has broken with the economy, and that does tend to bring equities down with it at first, but it does rebound though. But at first, like, don't if they do like a crazy rate cut for any reason, don't just think the stocks are going to skyrocket. That's not going to happen. They are definitely going to sell off because if they do an emergency rate cut, that means something's wrong with the economy, something's broken, recessionary fears, inflation, whatever it is. So markets will sell off. You have to understand that. But again, I don't believe that unless something like that happens, we'll ever go back to those low interest rates like that again. We can't sustainably, our economy, it's not feasible. You can't have zero interest rate. I mean, look, that's how all these landlords, these REITs, and all these banks like SVB back in 2023 that failed due to the amount of bonds they were holding, and they bought them at really high prices, and then interest rates went up, and then the bond prices dropped, and the yields went up, and they had to basically sell bonds, which bonds are basically a guaranteed safe investment. As long as you hold it all the way to maturity, you do get paid out on the yield that you bought the bond for. But they had to start selling off bonds for a loss before maturity because liquidity issues. And when they did that, with as fast as information travels these days, people like who are depositors at that bank, that was a red flag. So basically, you had a bank run that happened. Everybody wanted their money out, and then they failed, and that's what happened. I mean, just give you another little story there. That's exactly what happened. They had overexposed themselves on bonds when interest rates were low, and guess they didn't really think or weren't prepared for rates to go up. And as rates go up, bond prices drop, yields go up. And they were too exposed, and basically, yeah, they got basically margin called. I want to call it that. But anyways, I'm just saying, like, you have to look at more than just stocks, people. Bonds are very important. That's what Trump and Powell are looking at, or bond prices. Like, you start to see these like insane moves to the downside, on bonds, like very fast like this. Like, that is a very steep drop very quickly. That personally is one of the reasons I believe that Trump kind of flip-flopped, because if you start having the bond market, collapse, like, you got to understand, like Japan, China, like every country in the world, for the most part, owns U.S. Treasury bonds. Japan owns probably the most. I think they do. So when they start dropping in price like that, well, there's reasons for it, but these tariff things, other countries are not as attracted to investing into the United States right now. The dollar, bonds, I mean, with all this tariff stuff that's going on, you got the downgrade, all this debt. So, yeah, I mean, look, to be a good trader, investor, you need to understand all these dynamics, right? And be able to kind of, understand what it all means. Like the dollar right here, okay? Dollar has been dropping ever since it peaked in 2022 at 114. This is the DXY, it's a dollar index, but and this is a weekly chart. You got to understand something. The only time we ever saw the dollar or the DXY chart that high or higher than that, let's see, this is back in like the 80s, like the oil embargo stuff, right? Okay. I mean, look at that. Look at the rise in the dollar and then the immediate elevator crawl down. And then it, again, here in the 90s going into 2000s and the dot-com bubble, boom. And basically the dollar fell all the way into 08, did a little bit of this, and then in about 2014, it started to come back up. It consolidated around like the 95-ish level. And then you had COVID, which made it drop to about 90. And then here came the money printing. And then we topped out in 2022 with the inflation and the interest rate hikes. Now you're kind of seeing a little bit of a trend break here almost. So if the dollar goes down and the bonds go down, that's not good. That is not going to be good for equities either. Okay. Gold up. What's really weird, I noticed, I think it was like a week or so ago, like from an intraday basis, you had bonds, dollar, and gold all down, right? Which is very rare to see. While I think equities were up. Typically, dollar up, gold down, or dollar down, gold up. Bonds down. Well, I mean, that's hard to compare. What I'm getting at is you got to monitor a lot of different stuff. This is the Japanese yen, right? I watch it like hawk. And even look at crypto. You got to monitor crypto. I mean, it's kind of does now actually have an effect on markets. I don't know. But just being able to understand all that data, and that's going to make you make better decisions on your trades. So I didn't mean for this to be like a lesson on how to trade or like whatever. What I meant for this video to be is I want you to understand what could potentially we be walking into on Monday. You know, I mean, is there any more news right now? Let's see. I mean, Twitter might even be the best way to look at it. Okay, apparently an hour ago, JP Morgan trading desk. Unlikely we'll see another correction. Market poised to retest all-time high soon. I mean, I don't know. That's possible. Let's see. 4 minutes ago. Let's see here.
But we're seeing as a result the ports here in the because business has slowed down, as you mentioned. We're seeing as a result the ports here in the U.S. the traffic has really slowed, and now thousands of dock workers and truck drivers are worried about their jobs.
Yeah, that means we lose less money. You know, when I see that, that means we lose less money. Look, China.
What a clown, man. That means we lose less money. That means we lose less money. Oh my God. Okay, Michael guy. I really respect this guy. Japan's still gonna spark the credit event, fam. I like that, buddy. I'm gonna have to do a little repost on that one. Yeah, follow the lead live report. He's really smart guy. The sell-off that happened at the end of the day. Oops. That was all due to the Moody's thing. So, and this is where it stopped. Like after our trading. So we're not gonna know basically until Sunday evening when futures markets actually open up in the evening what we can potentially expect come Monday. Okay. I am telling you, I think it's gonna be bloody. I'm not saying we are going to go straight down, but I do believe that we will probably open up lower than this or even at this level, but I would imagine lower. And also anything can happen over the weekend. I mean, let's see what Trump says next, right? I don't know. But either way, so this coming week, I'll put on T-stars. Monday, we got a lot of Fed speakers, nothing too crazy. I mean, I don't know, just that lots of Fed speaking going on all the way into Tuesday. You do have your API crude oil stocks for Tuesday. Just a lot of Fed speakers. And then on Wednesday, okay, you got the 30-year mortgage bond rate. You get your crude oil stock changes, gasoline stock, okay. And then Thursday, you are getting your Chicago Fed National Activity Index, initial jobless claims, S&P Global Composite PMI, S&P Global Manufacturing PMI, S&P Global Services PMI, existing home sales, month over month and year over year, or month over month, and then for like the previous month, and then you have another Fed speaker, and then Friday the 23rd you have new home sales for April, and then you have new home sales month over month, and another Fed speaker. So lots of Fed speaking. Why is Powell speaking on a Sunday? That's odd. Okay. Anyways, well that's your data for this coming week. This is for next week. So we have not a lot of big names here so far. Home Depot on Tuesday morning. Okay. We got Palo Alto Networks. Okay. On their Tuesday after the bell, Toll Brothers. And then you have, let's see, Baidu, Target, TJ Maxx on Wednesday morning. You also have Medtronic, Wix, XPEV, and then after the bell, you got Snowflake, Zoom, AMSC, Domo, Urban Outfitters, Yeah. And then I'm just trying to go down here. I mean, you got analog devices, advanced auto parts, Ralph Lauren, TD, Deckers, Autodesk, Intuit, Ross, Workday. Yeah. Anyways, I'll post it in the server. So yeah, I mean, everything's overshot. I mean, just on the TSI, right? Let me go back to SPY. I mean, you have a clear, whenever the yellow crosses below the purple, you go down, right? No, it's doing it again. And vice versa, whenever the yellow crosses above purple, it goes up, and you got momentum starting to trim downwards here on the hourly. Sell signal, you got a sell signal up here. So, and like I said, 510, or I'm sorry, on QQQ, 510 seemed to be a logical put strike on a put for me to buy. Did I know this was going to happen afterwards? No, but I still thought we were, due for some kind of pullback, and I would think that at least 510 would be the, one of the levels. And like I said, I bought them when it was trading at 521. So it's an 11-point, difference that it needs to do. And I think they expire on the 23rd. So a week from yesterday. And you got these gaps down here. You got a huge gap, right? Like giant gap. So, and most gaps eventually do get filled. They don't want to get filled immediately, but if it breaks 510, I mean, you're looking at a potential gap fill and going back to the 61.8 fib. So yeah, man, I don't know. Oh, here we go. Last thing. So, yes, some pretty unusual option flows came in at the end of the day yesterday on SPX specifically. What's the highest one here? So you got almost a 300 million multi-order 5,000 strike call for June 20th. Now think about that for a second. The SPX is trading above that level, significantly above that level, right? It's trading at 59.58. So why would somebody why would they in $300 million in premium buy such a deep in the money call, 1,000 points, basically? Can anybody guess? It basically is showing you that this is like a hedge kind of play here. Like they're doing something on the other side of this. So this is a hedged play. I mean, same thing with this one. I mean, this is not as much premium paid, but the 4,000 call strike. So, and you got another 5,000 right here, right? And okay, the 6,000 one makes a little bit more sense because we're not there yet, and they gave themselves, almost 6 months, I guess. But it's when you see these ones that are just like already deep in the money, you just have to understand that is most likely it's a hedging. It's somebody big hedging because they're positioned differently on something else. That's what that means. So anybody who actually watched this entire thing, all right. Well, let's have a good weekend. We'll have an update on Monday. With that being said, I'll leave it with what I normally say. Chuck Tiz, Chuck Taylor, Chuck Boomer. He doesn't ask why. He doesn't ask why. He asks why not. Because why the fuck not? Oh man, sometimes I crack my own self up. But all right, folks. See you later.
you.